this is going to be one of the most important transactions in your lifetime, certainly the most
Absolutely.
expensive. So you need to work with somebody you feel the best connection with, the person you feel is going to get you to the finish line with the least amount of stress.
Yep.
And people forget that.
This is Lived In, a podcast by Hemby Home Company in association with Haystack Realty Group in Greenville, North Carolina. Lived In exists to host thought-provoking discussions on design and real estate, empowering everyday home dwellers to live beautifully, regardless of budget or circumstance. Every 2 weeks, join me, your host, Femi Koz, a realtor, design advisor, and content manager, as we cover everything from how to effectively conduct a home search to which rooms are worth the investment in your home. Together, let's find out what it really takes to live beautifully. This season, we're hosting interviews with experts, putting the keys in your hand as you make some of the most important decisions that come with creating a beautiful place to live. In today's episode, my guest is mortgage expert Jae Goess. Jae is a branch partner at Alcova Mortgage, which services Greenville, Whiteville, Farmville, Fayetteville, and Boone. And with 15 years experience in this market and in this field, she is the perfect person to host a conversation on what it really takes to finance your dream home. Let's get into it.
Jae, it is lovely to have you. It's kind of funny to do this like this when I'm so used to hanging out with you in person, but it's wonderful to have you. Thank you for joining me on the Lived In podcast.
Thank you for having me. I'm excited.
I'd love to start with just allowing people to get to know you a little bit. So obviously they know that your name is Jae, they know you're a mortgage expert. But where did you grow up?
Well, I suppose I grew up a little bit of all over the place. My father was military, and then even after military, we moved around a lot. But I'd
Yep.
say we settled into North Carolina in the early 80s, and I've been in North Carolina ever since.
Yep. Very cool. And have you always been in Eastern North Carolina, or have you kind of been in a few different places?
No, no, I didn't get to Eastern North Carolina until 1997. So I moved over
Okay.
to the East Coast from Charlotte. When we first moved from Virginia into North Carolina in 84, we were in, I guess, in the middle part of the state, in Winston-Salem.
Yep.
Yeah. hmm
So growing up military, does that mean that you moved around like a lot, or were you mostly in the same place?
We did move around, not in the way that I think the military today is, I think, quite a bit different. Speaking
Hmm.
to my veterans and my people who are still active military, they're
Yes.
going to Germany and they're going to Japan. We never
Right.
had that. My father, for the most part, was exiting out of the military, at the point that I came along. So a lot of our
Yeah.
moving was more transitional, right? A
Yes.
job application, relocating for this and that. And so we were just very transient. My parents were young,
Yeah.
and the younger the parents, the more transient you are, the more moving
Yes.
you do before you really settle into one spot.
So then, do you have a favorite home that you can remember that you lived in with your parents?
I, that's a great question. Uh, we used to make jokes when we were talking that we never really lived in one place for more than about 2 years at a time. My mother and I just not too long ago were making a joke because when we live somewhere for 5 years, we think that's a long time
Yes.
before we move to somewhere else. I would have to say my fondest memory or my best memory of a home that I lived in was probably applicable to its proximity to
Mm,
family, right? More so
yes.
than the actual structure.
Yep.
So there was a brief period of time where this was before we permanently moved to Winston. We
Yeah.
were in Winston-Salem near my grandma. My grandma was still living. And so I would say that was my favorite home only because it was close to her.
Yeah. Which I think you can have a favorite house and you can love the walls and you can love the paint and you can love all of that stuff. But I actually think it has more to do with who fills your home or who you spend time with in that home anyway. So
Yes.
that's not surprising
Yes.
to me. I
Yes.
love that.
100%. hmm
Let's pivot a little bit from your house to you helping other people buy their houses,
Sure.
which you're very, very good at. I, for those of you listening, I told Jae before the call or before we started recording that she's one of only two loan processors or loan officers that I've worked with who actually attend closings with clients. We'll get into closings and what exactly that is if you haven't bought a house, because nobody understands what that is otherwise. But she's very involved, very, very involved. And it's something I really appreciate about her. And she leaves absolutely no stone unturned. So, Jae, how did you get into working with mortgages?
Oh, wow. Well, I was in banking years ago, had my daughter, of course, married the first time, had my daughter, went into business with obviously my now ex-husband. We had a tile and remodeling business also in the housing industry.
Ah, yeah.
And yeah, I was involved with a lot of tile in a lot of the homes around town. But
Yes.
and I got to design and pick and create, and so much fun. I mean, what's available today is just unbelievable. I mean, it's almost sensory overload versus what was available in, when
Yes.
he and I were doing that in 2005, 2006. But so I was in banking, more of an accounting type of environment before, went into business with him. Fast forward, decided to split ways, got
Hmm.
divorced, and so with he and I running the business together, obviously we had to, go different ways with
With the business too, yeah.
business, yes, our career, so to speak. And so had an opportunity to come back into banking per se, but entering into a mortgage environment, residential mortgage lending, which I actually had not done before. I'd been in
Hmm.
several different levels and caveats of banking, but never the mortgage piece. So came
Yeah.
back into that in February of '09, and I've been
Oh,
here.
wow.
Yeah, I've been here ever since. So that was kind of how I got into it, as a collapse from one job to another.
Yes.
But I love it. Obviously I've finance and banking and math has always been my background, and my degree is
Hmm.
actually in education. So
Oh, wow.
I would say the most common comment I get from a lot of agents is, well, we like you the best because you actually take the time to educate,
Yes. Yes,
coach.
you do. You
Yeah.
really do.
And I think that probably comes from the education background mixed with
Yes.
what I'm doing now.
Yeah, absolutely. Um, Jay regularly comes in. So I do real estate at Haystack Realty Group, which again, if you've listened to the podcast for a while, you know that. But we regularly have local experts come in and just speak to us about, whatever their area of expertise is. And Jay is one of the best at coming in and explaining something that is maybe it's a new loan product or a new way of doing business. And she just explains it so well. And I've sat many times with you at the closing table where you've explained something to the people buying the house. So I agree. You really do, more than anyone else I know, explain it really well. There are a couple of attorneys that do that well too, but you do that really well.
Well, I think
So
it's important. And I think if a lot of your listeners are about developing space and developing their home, whether they're buying
yes,
now or buying later, everybody wants to feel informed. They want to feel good.
yes.
But I don't know that everybody in the world wants to read that deed of trust from start to finish. That's why we
Whew,
call it sleeping material. But
yes,
but you need the important stuff, right? And you
you
need
do.
a level of confidence that goes with owning versus renting, because it's just two very different things.
Yes, absolutely. I'd love to get into kind of the process of obtaining a mortgage. Something that I regularly wrestle with is kind of like the chicken and the egg, or the mortgage officer or loan officer or the real estate broker, because I never really know which one is the best one to have first.
Hmm.
Um, Sometimes it feels like, oh, you went ahead and got pre-approved. That's great. Now we kind of know what we're doing and you understand. But then sometimes it's like we went ahead and got pre-approved, and I'm looking at some things. I know, for example, I've had people be pre-qualified and then they've spoken to you and you've looked at the numbers and gone, I don't know how they're getting that loan. And I trust you because I've worked with you and never had any issues on the transaction piece. So um, I'm always in two minds as to whether it's better to have someone show up and they have no they have no pre-approval, and so they're like, well, actually we need help with that, and I can send them to you, or if I know that you're not going to be able to help somebody else. um, I never really know which one's the best fit, but I would love if you could explain kind of the first step in obtaining a mortgage, because I think people typically go, we want to buy a house, we think we can afford this amount, we looked on Zillow.
Yeah.
But it kind of takes a bit more than that. So what are the initial steps for obtaining a mortgage?
Yeah, I would have to say looking on Zillow is about as good as Googling why your finger is throbbing. By the end of the Google search, you've got cancer, right?
Yes.
Everything leads to cancer. It's like the 7 degrees
Everything.
of Kevin Bacon.
Yes. That's
So more,
hilarious.
mortgage lending can be that way. And what's unfortunate but true is that we have social media and resources that are intending to try and be helpful, but are they really? Because if you don't know
Yes.
what you're looking at, your interpretation of what you see is,
Mm-hmm.
oh, I can buy a $300,000 mortgage because it's telling me it's X amount a month. Well, what it's not
Right.
telling you is how much down payment. It didn't include
Mm-hmm.
taxes. It didn't include
Right.
insurance. It didn't include
Right.
mortgage insurance. It was based on you having an 800 credit score and putting 30% down. Well, how many buyers
Mm-hmm.
do we have like that? Not many.
Not many.
Yeah. It's
Definitely not in
like,
my experience.
yeah, it's like a commercial to buy a car, right? And it's like
Yes.
0%, 299 a month, and then in the small print, you're leasing, you're not owning. So
Right.
it just like anything else, buying a home is very much the same way.
Mm-hmm.
Which one comes first? Well, I think that is the power of relationships, right? So if
Mm.
somebody's coming to me and they don't have an agent yet, being able to pair with somebody like you that we know is going to help navigate them and explain things to them and put them in something that makes sense. And
Yeah.
then vice versa is equally true. If they're coming to the agent first, the agent having an excellent relationship, whether it's me or somebody else, but having that relationship that they, with 120% confidence, say, hey, I'm excited that you're interested in buying. This is
Yes.
what we need in order to start shopping. Because there's a
Yes.
difference between wanting to buy and actually shopping. And as you know, with
Yes.
the NAR settlement that's coming down the pipe,
Yep.
you're going to have that buyer's agency agreement. They're going to have a full understanding of what that expectation is before they can even go look at a house. So the
Yep.
last thing you need is to go through all that extra hype and all that extra paperwork that's coming down the pipe just to go see the house. And they're not even, and you don't even know if they're qualified to buy it, right? So that first date for free
Yeah.
is probably going out the window for
Yes.
sure.
It is. It's definitely going out of the window.
So with respect to that, how to get qualified, again, whether they're starting with me and going to you or starting with you and coming to me, it
Right.
is essential that we have an understanding of what they qualify for. And in order
Right.
to do that, they've got to complete the application, whether
Yeah.
again, whether it's with me, whether it's with, my Aunt Susie has husband's Johnny's sister is a loan officer at the
Right.
credit union, but you've got to have that first step. Get an
Yeah.
application under your belt. Let a mortgage professional do an analysis, figure out what programs you qualify for. Because here's another thing. It's great to be able to want to go and buy a house, but what if you don't have any money?
Right.
Well, I love it when people say, God's going to give me a sign, but that doesn't mean he's going to suddenly grow a money tree out your backyard. So,
Right.
do we need to be properly prepared? And there again, that's that social media trying to convince people, well, everyone should
Mm-hmm.
be home. That doesn't mean that there's a program for every single body out there who doesn't have money
Right.
to buy. So those are really important things that may be a little bit uncomfortable that you have to talk about.
And would when you're completing an application, is that when a credit check is also performed?
Mhm.
Asking for listeners. And I believe, and this is where you're the expert and I'm not, it's 30 to 60 days. There's a 30 to 60-day window where once your credit check has been pulled, if you're shopping around in multiple places, that's not going to further affect your credit score. Is that right?
Correct. When you're shopping for a mortgage, mortgage institutions all have the same code. They know that it's a mortgage pull, just like a
Right.
car. A car pull is something different. A credit card pull is something different. And so, how the bureaus weigh pulls is based on not only the amount of activity, but the frequency in which you do it. So, let me rephrase that. because all mortgage companies have the same pool, they know you're shopping for a mortgage. Guidelines, the federal guideline says that you're allowed up to 6 mortgage pools without negative impact to your score.
Oh, wow.
Do we recommend that? Heck no.
No.
Because who wants 6 different voices in your ear telling
Oh my
you A, B,
gosh.
or C, right?
Yeah.
I think 3 is more than plenty. Now, if you're a unique individual and you're looking for a program that just doesn't exist out there until you find
Right.
like the magic mushroom hiding under the Lucky Charm guy,
Yeah.
you may need more than 3. But
Right.
in my opinion, this is just my opinion, that goes back to relationship. So
Yeah, I agree.
why would you intentionally tell somebody to get 3 different mortgage pools unless you felt as if, 1 second opinion is one thing, right?
Right.
And let them decide, because look, not every shoe is made for the same person. So
Mhm.
maybe 2 people, one to compare against the other to get a point of
Right.
reference on rates and cost and in my opinion, personality. I
Mhm.
think I when I'm coaching people, this is the bottom line, and this is the truth, with exception of certain programs and certain nuances and exceptions. But 85% of the time, most lenders are going to be around the same ballpark. I
Yeah.
mean, the rates are dictated by the secondary market, and we all have to
Right.
follow the federal law.
Right.
So give or take a little here or a little there, or a little more here, a little more there. It's not going to be that different. Again, exception to a few program exceptions, but
Right.
so what I tell people is, who do you feel comfortable with?
Mhm.
Who do you want to have a relationship with? Because here's the bottom line. This is going to be one of the most important transactions in your lifetime, certainly the most
Absolutely.
expensive. So you need to work with somebody you feel the best connection with, the person you feel is going to get you to the finish line with the least amount of stress.
Yeah.
And people forget that.
Well, it's funny too I completely agree about the loan products. I think when it comes to relationship and personality, things that will concern me will be people who are difficult to get hold of.
Uh-huh.
People, like if it's a loan officer who's difficult to get hold of, or one who doesn't communicate very well with their clients about things they're doing. Like I once had one loan officer tell me um, tell me that they had discussed with the buyer that they were going to increase the price of the offer by, let's say, 5 grand, and then ask for that in concessions. And she explained that she had explained that to the buyer, and I had the go ahead. Well, I went ahead and filled out the paperwork, sent it to the buyer, and he's like, what is this? And I was like, well, your loan officer said that she discussed this with you. So things like communication, things like tenacity, and you probably it's like you and maybe 1 or 2 other people I can think of that are really good at problem solving when there's an issue in terms of qualification or finding a solution for a new problem that's come up. And so I look for some of those things as well. And then just reliability, because I've had, thank God, personally, in my own firm, never had it, but I know of other agents in the firm who have had whole transactions almost fall apart because the loan officer was just a hot mess. So
Sure.
I think of those things as well in terms of personality and just their ability to get the job done and get it done well. I never worry if I hand off to you. If I send you a contract, I know you will make sure that if there's anything I need to give you, you will ask me for it. If there's anything additional or something that I need to know, you'll let me know. And not all loan officers do that. So
Well,
I
thank
very
you.
much appreciate that.
Lived In is brought to you by Haystack Realty Group. I've worked as a realtor at Haystack Realty Group since 2021, and something that sets our team apart is the fact that we really do work together collaboratively as a team for our clients to make sure they get the best possible outcomes. This means each Haystack client gets expertise from their individual agent and the combined expertise of us as a group. If you're thinking about buying property and want some help, or if you'd like to know how much your land or property is worth, click the links in our show notes or go to www.haystackre.com. That's www.haystackre.com.
Okay, so Jay, what is it like if you're applying for a mortgage and you are self-employed versus being employed? Is it the same kind of application process? Do you need the same information? Do you need different information? I know the answer, but for the
Definitely.
listeners.
Yeah, no, definitely different information. So
Yeah.
that first step of doing an application essentially is going to be the same. And then imagine a Y in the road, right? You know, you go left and you're a W-2'd salary or hourly wage earning employee that has taxes taken out of their check every
Right.
week, every month, whatever. Or you take your Y in the road to the right and you say, you know what, I'm in business for myself, or you get a 1099 or, you know, what we call a Schedule C, basically
Yeah.
any income that you earn that is not taxed from your employer, you're self-employed.
Right.
So once you complete that application, you do have extra layers there of what we call a tax analysis to establish usable income. And this is a common misnomer for many self-employed is the number one thing they'll do, and then going back to the, you know, the young people who just prefer to do everything electronically, not talk to anyone.
Yeah.
Let's pretend they're self-employed. They go in, let's just say they mow lawns. They're a yard maintenance company, and last year they made $120,000, and they plug in that they made $10,000 a month, and you're
Mm-hmm.
like, wow, you know, they're pre-approved to buy. And she's in the number, same number again, $300,000 home. We're ready to
Right.
go, pre-approved. This is where number one. This is where online companies fail. This is where
Mm-hmm.
you need to have a mortgage professional that takes the extra time to go the extra step, because
Yep.
plug in your information, it spits out a pre-approval. No one, you know, and you're a yard maintenance guy, you own a company, you made 120 grand.
Right.
You put in you made $10,000 a month, they spit out a pre-approval, you're ready to shop, only to find out you've been in business for 1 year and you made
Mm-hmm.
120 grand before you took deductions against it, and your net usable income is 20 grand.
Ooh, yeah. Yep.
So now instead of making $10,000 a month, you make a whopping $1,500 a month. So
Mm-hmm.
what are you going to qualify for? So I think that's
Right.
the most common struggle that self-employed has, is that you have two layers there. You have the misnomer of what I made gross versus what I actually claimed in taxes.
Mm-hmm.
And having somebody who's going that extra step to do that analysis to establish what your usable income actually is. So it's definitely
Right.
a different layer there.
So what other things are you looking at during when someone's applying for a loan? You're looking obviously at income. And then can you explain the DTI, what that is for our listeners? Because a lot of people say, yeah, my credit score is blah, 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 blah. And I'm like, that's great. But then they explain kind of what the rest of their finances look like. And I'm like, oh, you might have to wait a while.
Sure, absolutely. So obviously, credit score is one very important starting point. That's our first brick.
Yes.
Just like a house, you know, we kind of build it from there. The starting point is the score. If you don't meet a minimum score qualification, it doesn't matter what other programs you qualify for, how much money you make, your score is not going to get you off the ground. So
Right.
credit score is definitely the first piece of that.
And what's the minimum there? Sorry, just again for listeners.
Sure. No, different banks have different requirements. For instance, we go all the way down to 600 on VA, whereas believe it or not, like your Navy Federal, they go to 640. You know, they stop at 640, whereas we go down to 600. So there's going to be some variance to that answer. 600 is really where most of our programs start. If
Mm-hmm.
you're going to do any sort of down payment assistance, that is navigated and regulated by North Carolina NC Housing. Their rates are regulated by them. Their scores are regulated by them. Their minimum score is 640.
Yeah.
And then, of course, conventional lending, you're going to be looking at 620 and up, because that's
Yes.
nuance. So the quick answer is 600 and up for us here at Alcova.
Yes.
And then you're going to have additional layers on top of that.
Right.
From credit, absolutely, to your point, becomes what is our income versus our debt load. So DTI, debt to income, is what those initials stand for. And we're looking at ratios. So by law of percentage, you know, the average homeowner, it used to be the average homeowner did not want their housing, so their principal and interest portion of their mortgage, their taxes, their insurance, basically their total monthly mortgage payment, by law of conservatorship, was ranging between 29 and 32% of their monthly income.
Yeah.
Yep. So, and then total income there again is going to vary depending on program. So we have
Right.
programs that have hard stops at 41% for total income, which is going to look at not only that new house payment,
Yeah.
but any other additional debt, and they're going to add those two together, not to exceed 41, all the way up to 55%.
Yeah.
So your ratios are going to change as well, depending upon program.
Yeah. And then is there anything else that would feed into that that you'd be looking at in terms of whether or not somebody can qualify for a loan? Or are those really the main two bricks?
Well, you are going to have other layers there. Let's say you're divorced and you pay child support. That's a debt.
Right.
It's not going to show up on the credit report, but it's something that, again, if you're working with a good mortgage professional who's combing your file or asking those questions, because guess what? Once it goes to underwriting, like you were saying, your pet peeve of things falling apart at the end, it does you no good to pretend that you're not paying child support, because
Right.
eventually somebody's going to find out.
Somebody's going to find out.
Yeah,
It's
or they're going
true.
to see it on your bank statement, or they're going to see it on your pay stub. So, banking is very transparent now, and you don't have to tell the whole world, but you do have to tell your mortgage professional.
Yes.
Otherwise, they can't protect you. They can't protect the money that you're going to invest to try and buy.
I
That
think
due
it's,
diligence and that earnest money and the things that you lose.
yes.
Yeah.
I think it's funny because I think a lot of people, and I understand it, a lot of people are uncomfortable talking about the money that they make
Mm-hmm.
and what their finances look like. But
Sure.
I also think that people need a very full picture. When I'm talking to a first-time home buyer, and I know that I have to be careful not to overshare. I don't want to intimidate, but I will always tell people, they'll say, yeah, we're thinking we've got 25 grand to cover, deposits and closing costs. I say, that's great. Have you factored in the cost of moving house? Have you factored in the inspections? Have you factored in the cost of the appraisal that you're paying out of pocket? Like all of those things also need to be taken into consideration. And a lot of that, again, is going to come down to the relationship. So the person that you're talking to, their experience, what they know. I know that when we bought our house, I had a spreadsheet, which I've actually since shared with clients, that
That's great.
literally factored in, okay, you're moving into a house for the first time, you're buying a house for the first time. What appliances are coming with the house? Do you need to factor that into your payment? Who's moving your stuff? Do you need to factor that into your finances? Just all of that extra stuff that people don't always think about. So I love that you were mentioning all of
100%.
those.
I love that you share your spreadsheet. That's great.
Thank you. I think it's helpful. I think it just helps people to be able to have the fuller picture. Everybody doesn't think the same way. So
Well, people don't know what they don't know. And so
exactly.
to conceptually, it sounds great to be able to buy a home, but
Yes.
realistically, are all of those layers in place for it to be optimal?
Right. Yes. Yes.
Of course, they say that about having children, it's never optimal.
Oh
You
my,
just have them.
yeah, correct. There is no right time. There is no right
Figure it
time.
out
There's no
later.
perfect way. Yeah, it's just, you just have to kind of saddle up. There are really bad times to have one, but there's no perfect time. So, okay, you spoke about depends on the program. Can you give us a kind of broad overview of the different programs that there are, general programs that people would be familiar, well, they might not be familiar with, but that they might come across if they go and speak to you, for example, and they say, what type of loan should I go for?
Right. Or they're Googling or Zillowing or,
Yes.
doing research online. Obviously they're going to run into the basics such as conventional
Yeah.
loans, VA loans, which are for veterans only, FHA, which stands for Federal Housing Administration. Those are great loans for people that obviously have slightly lower credit scores, lower down payment.
Yeah.
They when they came about in the 70s, it was to provide home ownership availability to everyone, right? So
Yeah.
it created the beauty of the FHA product is it created an environment that the conventional loan did not have at the
Right.
time. And it still exists today for that reason. So you of course have those. And then you can add on to there the layers of the specialty items, right? So there's special programs out there now for people that make income under a certain amount. They essentially get certain interest rate exceptions. They have what's called a delivery cap on those. So it helps
Yeah.
keep their interest rate slightly lower if they make under a certain amount of income annually. It
Yeah.
additionally will keep their MI mortgage insurance lower. So you have those types of products. They're not only for first-time home buyers anymore, they used to be. Now those two,
Oh,
now those two particular products are weighed strictly based on income. So if your income is below a certain income limit that's set by each county separately, then
yeah.
you qualify for that. Now, you're not going to qualify for instance, for the 3% down first-time home buyer unless
Right.
at least one person on the loan has not owned in the most recent 3-year period.
Right. So it doesn't actually, and I don't think a lot of people know that because I didn't until I started doing this, that you don't actually have to be a first-time home buyer. You just have to have not purchased within the last 3 years.
Correct.
Just kind of crazy.
It's like your reset button, right?
Yes.
And NC Housing, they don't, and this is a misnomer from them as well. They don't necessarily require you to be a first-time home buyer. However, you cannot have owned a home within the most recent 3 years to qualify for the down payment assistance. So
Yes.
if you have somebody who doesn't own because they sold their house a year ago and they have no money in the bank and they want to use down payment assistance, guess what? They don't qualify.
Right.
So
Yeah.
there is a first-time home buyer overlay on that down payment assistance program.
Right.
So again, there's so many layers there and different ways that you can go about it. Of course, the state programs are great. Another misconception is, oh, that 15,000 is a grant, and I'm hearing this a lot lately. I don't know who created the
That's myth.
incorrect
Yeah.
vocabulary, but it is not a grant. It is not it is eventually forgiven, but it is not grant money.
Right.
It is not granted to the borrower that qualifies for it. Now the beauty of it, what it is it is essentially a 0% interest accruing second loan that we call sits silently. So it sits silently in the background. You don't owe no pay,
Yes.
you don't owe a payment on it. However, if you sell your home or refinance your home, of course you have to give that 15,000 back to the state.
Right. And that's in a certain time period. Correct?
Well,
Or is it
right.
just
If you own that home and don't refinance and stay in that home for 15 years, it's completely forgiven. And in starting year 11, a percentage each year from 11 to 15, a percentage of that 15,000 is forgiven each year.
Yeah.
Years 11 through 15.
Yes. Yeah, again, when I tell people about that, I'm like, hey, you don't have to pay anything on it, but if you sell your house before then, you are going to have to pay it. And that's something I know other agents have run into with sellers who had that and weren't well informed.
Right. And then there's that extra 15 they've got to pay at closing.
Yes.
Exactly.
Which sucks.
Yeah. Well, it doesn't, again, that goes back to education and preparedness.
Correct.
If you prepare your client and you properly educate, then they know. Sometimes they forget, in defense of that, because they're not making a payment on it. And so you just kind of forget.
Yeah, that's true too. What surprising things? So let's say I've applied for a loan, and then I've been pre-qualified. Actually, can you explain the difference between pre-qualification and pre-approval?
Well, again, I think that was vocabulary a little bit created by the industry to try and differentiate one versus the other. I shouldn't say in the old days, at some point, and what's funny to me is that vocabulary it seems to very much be an Eastern North Carolina thing, separating that pre-qualified versus pre-approved. But anyway, somewhere down the line, an agent decided that somebody who is pre-qualified is not the same thing as being pre-approved. The true vocabulary of pre-approval being you have physically looked at their income, you've looked at their assets, you essentially have pre-approved, as in you sent it to the underwriter without a property to attach it to, and the underwriter literally underwrote the file, gave you a list of conditions and said, this is what I need to approve the borrower and clear them to close a loan that doesn't exist yet.
Yes.
So if you want the true definition of the two, how many times is that borrower actually sent to the underwriter reviews the file, sends you a list of conditions, and you can close on that loan in 1 week?
Yeah.
Almost never. So the truth of the matter of it is, when somebody sends you a pre-approval letter or a pre-qualification letter, the real question is, if you're concerned about the credibility of where you got that letter from,
Right.
reach out to them, hold them accountable for, have they actually looked at stubs? What layer, at what level have they truly, quote unquote, pre-approved or pre-qualified
Yes.
that borrower?
Yeah.
Yeah. Because because honestly, just the words in and of themselves, I feel like is about as clear as mud. So
Right. Okay, so let's go to that scenario. I've been pre-approved. I have put in an offer on a house. The offer has been accepted. What surprising things could ruin that a home buyer could do that would mess up that loan?
well, they could go buy a car,
Yeah.
Certainly getting your credit pulled after you have been pre-qualified or pre-approved is a no-no, even if you haven't located a home at that point, because the underwriters can see on the back end that you've had your credit pulled to go buy a couch or go buy a fridge or go buy a car. They can see that. So if you don't disclose it, and again, we haven't properly protected you to buy in a price range that you could afford to buy based on things we can see, inevitably those things will be caught down the line. So I think the number, going back to some things we've touched on a couple of times during the call, full transparency is key. You're only telling me, and I'm not afraid to tell you, I'll have conversations with people and I say to them, look, I'm here to protect you. This is just you and I talking. This isn't your agent knowing what we talk about. This isn't even the underwriter knowing what we talk about. We may be strategizing on something, in order to minimize stress or to minimize paperwork, or, there are any number of things that we create strategy around regulation. So, but still follow the law, right?
Yeah.
So, I won't delve too far into that, but I would say complete transparency is key so that we don't run into surprises. If you pay alimony, disclose it. If you pay child support, disclose, and the things that I'm referencing are debts, right? Because let's go back to debt versus income. If you have a debt that you don't disclose and we've qualified you based on not having that debt, and then all of a sudden that debt is discovered, that's what's throwing your loan out of whack.
Right.
And I've had people say to me, well, I don't understand why it's an issue. I pay my bills. Glad you pay your bills.
Good for you. Right.
But our job is to make sure you continue to be able to pay your bills. And if you're entering into a mortgage transaction that is not going to allow you to keep your head above water, whose fault is it? So who are you going to point your finger at? Well, she said I was okay. Yeah.
Yeah. Yeah.
So.
Something else that could maybe ruin the mortgage loan application would be if there was, I don't know if this was actually, I've had experience, and I mentioned this before we started talking about a client, or two clients, actually, a couple who then got promoted. And so they were initially planning on down payment assistance and they couldn't get it anymore because they earned too much, which is frustrating because sometimes it feels like you barely earn enough. You're like, how? But you earn too much to get that. Is there anything else? Would it be a problem if they changed their deposit amount, or if they needed to switch loan types in the middle of being under contract on a house?
Well, certainly switching loan types has happened. Is the fact that someone got a promotion, it happens. And sometimes it's happened and it's not a reflection on one check stub, but then it is a reflection on another. And that borrower, unfortunately, just didn't have the wherewithal to share with the mortgage professional what was going on.
Right.
Again, that goes back to actually having conversations and educating. One of the things I'm educating with down payment assistance is there is an income cap. They're gonna, and if you are a penny over, it is a hard stop. So let's talk about, and I have this conversation with my borrowers specifically who are working overtime, because they have that conversation with you. You're like, are you prepared for this? Are you prepared for that? And they're like, all right, I'm gonna work all this overtime. I'm gonna make sure I have plenty of money for this house. And then all of a sudden that overtime looks as if, from a calculation standpoint, a lot more money than they actually are. So you've got to be really careful with things like that. And so when I'm coaching my clients, if we're doing that down payment assistance, hey guys, we are close to the cap. That means
Yes.
don't work extra overtime. Don't, do you get bonuses? Do you get upgrades? Do you get incentives?
Hmm.
Do you get commission? Anything, to your point, that could potentially throw us over, we need to stay even Steven until we're done.
Right.
And usually if you're actually having those conversations with people, that's going to come out in conversation.
Right.
That's why it's so important. You don't have to spend the amount of time you and I are spending right this very second. But
No.
education is so important so that you avoid things like that.
Yes.
You know,
One more thing on the
and
job. Sorry, Jay. Changing careers could be a big issue too.
oh yeah, changing jobs is a no-no in the middle of any transaction, not just
Yeah.
one that's an income cap.
Right.
Because if you're changing jobs, let's just pretend, and this does happen as well, even for a physician. You're a W-2 physician, and now you want to open your own practice. Well, now you're self-employed. Well,
Right.
self-employed requires a 2-year tax return history. So now you're dead in the water, even though you're a $200,000 physician.
Right.
So it really doesn't matter what your profession, you have to be very careful with things like that.
Yeah. If when people are like, well, I'm thinking about changing jobs, I'm like, wait till you close, and then change jobs. Don't do it until your deed is recorded. Don't change jobs.
Yep.
Just
Yeah,
don't.
because they'll check the
They'll
day
check.
before closing.
Yep,
They
they
sure
will check
will.
the day before closing.
Random deposits, cash deposits into their account.
Oh yes, I've had
You want to
clients say to me before, I don't have money in my account, but I have XYZ saved under a mattress.
Yeah,
I'm like,
no.
oh, it's going to get flagged. Yes.
Yeah.
Don't because they're looking for fraud. So, which is a good thing.
Yeah.
So don't do that. Put money in an account somewhere, please. How do interest rates impact mortgage payments, and what are some strategies that borrowers can use to secure the best possible rates? So I know, for example, a better score or a higher score will likely get you a lower rate, except in some cases where a lower score can actually get you a better rate, which is a weird thing. But what are some ways that borrowers can have a lower interest rate on their house?
Well, I think that the score definitely is a factor in obtaining rate. As I mentioned, there are certain specialty programs out there that help with rate, income caps. You have specialty
Yes.
programs that have, if you're below a certain median income, then you get what they call a cap to the rate, which means there's only so many ways it can adjust. So people with higher credit score, it still lends itself to benefit. I know that all of that language came down the pipeline, that they're punishing people with good credit in order to help with bad credit. It doesn't quite work that way. Again, not enough time on a podcast to explain all that, but so
you have to call Jay personally for that one.
Yeah. You're definitely in a situation where the better the credit, the better the potential for the rate. Absolutely.
Yeah.
Obviously, the potentially the more down payment you have, potentially the better the rate. So there are any number of things. Rates, for the most part, loan program. For instance, you might be on a conventional loan at 6.75, and you may be on an FHA at 6.125, but then your mortgage insurance on one is lower than the other, or do you have mortgage insurance at all? It's actually going to move quite a bit depending upon each individual structure. So there again, rounding back to education and coaching, are you looking at their loan possibilities a couple of different ways, if there are different ways, in order to capitalize on what might be best? Because here's the thing, not all rates are created equal. They never are, they never were. No. They're never going to be. So what works for one might work for another. I'll give you a perfect example. I had a borrower right now. She just texted me, and she's under contract to buy. She qualified for a reduced interest rate program on a conventional loan.
Okay.
But the money out of pocket is slightly higher than on an FHA loan.
Right.
And so I proposed both to her. Hey, here is what your monthly payment would look like on conventional. Here is what your monthly payment will look like on FHA. The payment on FHA was higher, but the money due at closing was lower. Right. So not it, the bottom line to say, not everything's created equal. If you have an opportunity to explore it a couple of different ways, because And her decision, her text came in while we were talking was, hey, I'm sorry. I've been on a call. We've talked about it. We'd rather go FHA. So,
Yeah.
they would rather pay $80 more a month because they're bringing less money to closing. So,
Right.
whereas, you know what, guess what? The next person may feel the opposite. So
Right. Yeah.
I think you just need to
Exactly.
explore every way you can, because the rate always, the rate is not always the big driver.
Right. That's true. It's funny because again, we do these coaching. We have these kind of lunch and learns at Haystack Realty Group about once a month, probably more. And we also have coaching calls. And one of the things that we've spoken about a lot is in the current market, and I'm talking North Carolina, yes, interest rates are high. They're in probably the 7.6s. Is that what you're still seeing, Jay? Sevens and sixes?
Now, I right now I'm mostly in the sixes. I
Mostly in the
mean,
sixes.
obviously, yeah, you're going to have your investors are going to be in the sevens. Your
Yep.
DSCR products are certainly sevens to eights. Manufactured housing, certain structures are going to
Yes.
be well into the
Higher rates.
sevens.
Yeah.
Mhm.
But even with that, and yes, that's way higher than the twos and the threes that we were seeing in 2021. But there's a new area where there are advantages that can be taken, and that is when it comes to house prices, because houses are sitting so much longer on the market now that yes, you can't buy a house for the same amount at the same interest rate that you could have bought it in 2021, but now you could probably negotiate and end up offering under asking and have that offer accepted, and you're not competing with a bunch of other offers. So there are still advantages. And a lot of people don't know that you can ask for, and there are limits on this dependent again on the program, like you were saying, but a lot of people don't know that you can actually ask the sellers to pay for things like closing costs or for some seller concessions, and you can use that money to do rate buy downs as well.
Absolutely.
So there are always options. I'm always trying to push. Let's see what options there are to make it happen and make it work if you're looking for a house.
Absolutely.
Okay, let's do one last question, and then I'll free you to get back to saving lives everywhere, Jay, and putting out all the fires. What advice would you give to first-time home buyers who are navigating the mortgage process for the first time? If you had to narrow it down to like three pieces of advice, or just one, but if you could narrow it down.
Yeah, I obviously what's on my heart and what I'm the most passionate about are probably the things that I've said a few times during the call, and that is
Yes.
connect with a mortgage expert that you can build a relationship with, that's going to educate and coach you, because sometimes just when you think you don't know, right? There's so many caveats, there's so many nuances, especially to your point, if they're a first-time home buyer, there's a lot of extra layers there on those first-time home buyer programs that you may or may not fit into, which if you're just, getting basic information online, just enough to get in trouble, right?
Right.
Which would bring me to my second thing. Just stay off of too much research online without actually investing the time to actually talk with a person that can help you navigate what you're reading online.
Yes.
Because I don't misunderstand me. I think education is key, but you need to have the right kind of education. And so if the only thing you're doing is reading things online, your perception is not necessarily reality.
Right. Yes, that's really good. That's really good. Jay, if people have more questions and they would like to talk to you personally or connect with you, what's the best way for them to reach you?
Oh, I would be happy to help any way I can. I always encourage people at this point to reach out on my cell. I think that, again, in the days of people preferring text over voicemail and things of that nature, and conversely, the other reason I predominantly use my cell phone now is because once people do start the application process, there's so much spam and junk and hacking and people calling because they can see that you're shopping for a mortgage.
Right.
So you start getting every phone call under the sun. I encourage people to save me in their phone. Don't answer calls you don't recognize.
Right.
You might be shocked at who may even get calls just from this podcast.
That's true.
It's scary, but true. But a couple of numbers, I'll give you my office. My cell phone is 252-814-7464. My office line is 252 I don't even
Yep.
know it. 439-0547. So again, office is 252-439-0547 and cell phone 252-814-7464. They can find me online at jaegoess@alcova.com, which certainly would take them to my website, the application, the home buyer tools, mortgage
Yep.
calculator link. So there's a lot of really fun stuff on the site as well.
Yes. Well, obviously, Jay, I appreciate you professionally very, very much. I'm so grateful that loan officers like you exist, people who
Oh,
know
thank
their
you.
stuff and care
You're
about
welcome.
people. It's a good combination. So thank you so much for joining me for the interview. And I'm sure that this will have provided immense value to a lot of people who are wondering what the next step is in terms of buying a house.